All right, let's talk about something that catches so many people out: inheritance tax on assets you own outside the UK. It can feel like a real minefield, but today we're going to clear things up with this discussion arranged by the experts at Pro Tax Accountant. So let's get right into it.
I mean, who wouldn't want that, right? It sounds absolutely fantastic. But once that initial buzz wears off, a really important question should pop into your head. How exactly does the UK tax system view these assets from overseas? That's precisely what we're here to figure out.
Okay, so before we get into the really tricky stuff, let's just lay down the groundwork and make sure we're all on the same page about what inheritance tax, or IHT, even is.
So what is inheritance tax really? Well, at its heart, it's a tax on a person's estate. That's everything they own when they pass on. Their house, their money, their investments, the whole lot. But, and this is a big but, it doesn't apply to every single penny.
And here's the magic number you need to know for the 2025 to 26 tax year: £325,000. IHT generally only comes into play when an estate is worth more than this. Think of it as your tax-free allowance, what the pros call the nil rate band.
Now this is the part that so often trips people up. If your permanent home, your domicile, is in the UK, HMRC doesn't just care about what you own here. Oh no. They take a look at everything, no matter where it is in the world. Your entire worldwide asset portfolio is on the table.
And the tax rate? It's a steep one. We're talking a standard rate of 40% on anything that's over that tax-free threshold. There is, however, a little bit of a silver lining for the generous among us. If you leave at least 10% of your net estate to charity, HMRC will cut that rate down to 36%.
So, this brings us to probably the most crucial distinction in this whole conversation: the difference between residence and domicile. They sound similar, but in the eyes of the taxman, they are worlds apart.
You know, people throw these words around all the time, right? But for tax, they are not interchangeable. Residence is pretty straightforward. It's about where you physically live year to year. Domicile, though, that's a much deeper, stickier concept. It's your permanent home, the country you're fundamentally tied to, even if you live somewhere else. Just moving abroad for a few years doesn't automatically change it.
And check this out. This number is a real game changer. There is a rule that says if you've been a UK resident for just 10 out of the last 20 tax years, your entire global estate can be on the hook for UK inheritance tax. This is a big deal because it's a shift away from that slightly fuzzy idea of domicile to a much more black and white residency test.
So, knowing all of this, what can you actually do about it? Well, you don't just have to sit back and wait. Let's get into some of the proactive strategies you can use to manage your potential IHT bill.
This one is probably the most famous tool in the IHT planning kit, the 7-year rule. It's all about giving gifts. You can give away assets. These are called potentially exempt transfers. The catch? You have to live for 7 years after you've made the gift. If you do, that asset falls completely outside of your estate for tax purposes. It's a powerful way to pass on wealth.
But gifting isn't the only option. Not by a long shot. There are other powerful reliefs out there. For business owners, business property relief can be huge. It can slash the taxable value of your business assets by up to 100%. And for spouses, any transfers between UK domiciled spouses are completely IHT-free. Just watch out for that cap if your spouse isn't domiciled in the UK.
Okay, but what if you're getting taxed in, say, France and the UK on the very same asset? Nobody wants to pay tax twice, right? Well, that's exactly what double taxation treaties are for. The UK has agreements with lots of countries to stop this from happening. You can get a credit for tax paid abroad against your UK bill, but, and here's the key part, you have to remember to actively claim it.
All right, let's flip the coin. We've talked about the smart things to do. Now let's talk about the common mistakes to avoid. Honestly, knowing the pitfalls can be just as valuable as knowing the strategies.
So what's the number one most expensive mistake people make? It really just boils down to one word: assumptions. Let me show you what I mean with a real-world scenario.
So let's meet Sarah. She's a business owner from Manchester, and she inherits this beautiful £200,000 villa in Spain. Her very first thought is, great, it's in Spain, so UK tax can't touch it. As you can probably guess, that simple assumption turned out to be a very costly one.
And here's the bill: £80,000. Why? Because Sarah was a UK resident. Her worldwide assets were in play. That Spanish villa pushed her estate over the tax-free limit, and boom,
An £80,000 IHT bill that nobody saw coming. A really painful lesson.
And Sarah's story isn't unique. We see other common slip-ups all the time. Things like underreporting assets, maybe forgetting about a Swiss bank account, or just assuming that because you moved to another country, your domicile status has magically changed. Another big one, ignoring currency swings. The value of that asset in euros can change dramatically when you convert it to pounds for the taxman.
Okay, so with all those warnings ringing in our ears, what should you do right now? Let's walk through a clear, simple action plan to get your affairs in order. Here's your checklist. First, confirm your residence history. Next, make a detailed inventory of every single foreign asset and where it is. Step 3, get them all valued professionally and make sure that valuation is in pounds sterling. Fourth, make sure you're using the right forms, like the IHT 417 for overseas assets. And finally, double-check every single relief and tax treaty you might be eligible for. Don't leave money on the table.
Look, if there's one thing to take away from all this, it's that out of sight does not mean out of tax when it comes to HMRC. Your foreign assets are very much on their radar. Since everyone's situation is unique, getting advice tailored just for you is absolutely essential. For that, you can contact the experts at Pro Tax Accountant, who arranged all the insights for today. So I'll leave you with this question. Is your estate plan truly global, or does it have a costly blind spot?